Welcome to Chit Chat Stocks. Before we get into this episode, we want to talk about our friends at Public. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account at public.com. That's a pretty big deal because when rates drop, so can the interest you earn on your investment. A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments, but you might want to act fast because your yield is not locked in until you invest. The good news, it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome to Chit Chat Stocks. Today, we are joined by a longtime friend of the show, multi-time guest. I honestly have lost count at this point. He's been on the show so many times, but it is John Rotonti. John is a portfolio manager of the soon-to-be industrial and infrastructure portfolio at Isla Mirada Investment Management. And I am particularly excited to talk to John today because it's a unique time. He's about to launch a new fund. We're going to go through his philosophy, and we're going to talk about some of the unique challenges involved in actually starting one, getting one off the ground. But I guess to kick things off, John, welcome to the show. Question for you. What are you reading right now?
Ryan, thank you. I have also lost count. I think this is 5 or 6 even. We're going to have to ask Brett. I know he keeps good logs of this, but 5 or 6 times I've been on the show. Thank you for having me. Love always coming on the show. What am I reading? So what I read really depends on the time of year it is and like the season of the work season. So right now, a lot of firms are putting out their market outlooks for 2025. So I read 8 or 9 of those. Believe it or not, our founder and my boss, Cale Smith, emailed me a couple days ago, 13 of them that he read. And I was going through them and checking. I had read 8 of them. And so like Liz Ann Saunders and her number 2, Kevin Gordon at Charles Schwab, put out a good one. Torsten Slock from Apollo. Richard Bernstein put out one. Henry McFay from KKR. Goldman Sachs, which is the platform we're on. So I read all of those. So those are the market outlook. But then also right now, Wall Street analysts are putting out their sector-specific outlooks for 2025. And so I read those, particularly the ones appropriate to the portfolio that we'll talk about. So industrial, infrastructure, and housing related. So that's kind of the second category I've been reading. In December, Goldman Sachs had their annual industrials conference, which is just fantastic. And so I've been reading a lot of the earnings transcripts from that conference, as well as some of the analyst reports from that conference. That's the third thing. Some companies are putting out investor days towards the end of the year, like in December. Several companies that I follow put out investor days. So I'm reading that as well. And then, of course, it's seasonal. So starting now, kind of over the next couple of weeks in January, my reading will shift to earnings transcripts because we're about to get into earnings season again, and then fourth quarter investor letters that I admire and follow.
Sweet. Yes, something I love about your process and your investment strategy overall is it's much more refined and, like, I guess, systematic, it seems like. I remember we were talking last time and you said all the steps you go through once you found a new idea, and it's like I hopefully find a good write-up and kind of go from there and read a 10K, and yours is just much more regimented, which I love. I'll also say you are a fan favorite on this show if
Thank you.
listener stats
Thank you.
tell us anything. And so people might actually follow you and have followed your career a bit. But for those that haven't, tell us about, um, I guess, where you're at today and this portfolio that you're launching later this month.
Um, I love being a fan favorite. This is, my favorite podcast. It's definitely the one that I've been a guest on the most. Pretty sure it's the one that I was the first guest podcast appearance I ever made. I'm pretty sure was on your show. So I'm grateful and honored to hear those stats. Uh, yeah, so I think August 1st of 2024, I started working at Isla Investment Management. We are changing our name. We're rebranding ourselves. I'll mention that really quickly this month to Bastion Fiduciary. And the reason is just because when Cale founded the company in 2008, virtually all of his original investors were from Isla Morada, which is an island in the Florida Keys. And the other early portfolio manager, Loretta Reeves, who is still a portfolio manager, lived in Isla Morada at the time. But now we have clients in 22 states, and our team has grown and is distributed across 7 states. So we no longer want to be associated just with the brand of Florida. So we're changing our name to Bastion Fiduciary. Bastion is like a star-shaped fortress, and so that sort of gives the image that we want to, I think, first and foremost, protect our clients' capital, preservation of capital first and foremost, and then, secondary goal is to compound that capital over long periods of time. Also, kind of protect them from some of the noise and nonsense out there. Some of it may be coming from Wall Street, but not all of it. There's a lot of it on social media these days too. And so kind of protect them from that noise and nonsense. And then the Bastion also shows respect to Cale and 3 other members of our team that actually served in the military. So we're changing our name to Bastion. Since day one at Bastion, I've been working towards this moment, building this portfolio. You could say I've been working toward this moment for the last 25 years, building up my knowledge and conviction in a group of high quality, profitable growth businesses, what I consider to be the highest quality businesses in the US. And there's probably 100 of them. It's basically my investing universe. It's going to be a domestic only portfolio that I launch, Ryan. And yeah, all I do, the firm has taken all administrative duties off of my plate. I mean, all administrative duties off of my plate. All I do is read and think and write about my investments, think about the portfolio, and communicate with our clients in several ways. And that's all I do is read and think about the portfolio. The portfolio specifically, it's going to be domestic only. And by domestic, I mean that their primary exchange is in the US and they report in US dollars, in USD. So there are some companies headquartered in Ireland, but they're US companies. That's okay. That is perfectly fine. They're headquartered in Ireland for like weird tax reasons, and it doesn't always make sense. But they're great businesses, and they're domestic US businesses, even though large portions of their sales could come from overseas. I think the S&P 500, 30 or so percent of the sales come from outside of the US. But this will be a domestic only, high quality value portfolio that invests in infrastructure, industrial, and housing related stocks. That's much more broad and diversified than it may sound. It's going to be a very low turnover, low activity, low trading portfolio. Yeah, roughly 30 stocks. And when we launch it, this is important to know, we're going to launch with roughly 30 to 35% cash. It will not be fully invested on day one. And really, I wouldn't ever expect it to be fully invested. This is something clients need to know. I'm very sensitive to the fact that when someone gives a money manager their money, they want it invested. I totally understand that, but that's not how I'm going to add the most value to my clients over time. I would suspect that when we launch, it'll be roughly 30% cash that I hope to deploy rather quickly if the market gives me opportunities. But on average, I would suspect it will have 10 to 15% cash. And when we get broad, violent, hopefully, market sell-offs, I will happily quickly take that down to below 5% or even lower. But this portfolio will not be invested at all times.
Okay, sweet. And we're going to
Will
talk.
not be fully invested at all times. Sorry.
Okay, important caveat.
Yeah.
We're going to talk a little bit more about the portfolio management process here in a bit. I I'm curious though on the stock research, stock selection process. What does that look like? What has the stock picking strategy looked like for the portfolio? And has it been you've had companies in mind for 4 or 5 months, I guess, or are these companies you've been studying over the last 25 years and you know what you want? I will say before we hit record, we were talking about some of the companies or the classification of industrial and infrastructure, and it is a lot more broad than I think people imagine. So maybe, I guess you can go through, just the portfolio selection process overall.
Yeah. Some of these companies I've followed for 2 decades. I mean, that would be accurate to say. Some of them I've followed closely for 5 or 6 or 7 years. A few of them are newer to me in that I started researching them in the last year. Um, before I answer your question, which is a great one, and I promise I will, there is this almost like mythical power that are given to portfolio managers and analysts that say that they researched a company for 2 years before making an investing decision, right? I don't operate that way. I will happily and patiently wait 2 years to buy something if that's how long it takes for the market to give me an opportunity to get in. But if it's going to take me 2 years, forget 2 years. If it's going to take me 6 months to understand a business well enough for me to buy it, then I don't understand it well enough. Honestly, like I can get up to speed on a company and I can build deep conviction in a company in 2 weeks, honestly. Not always, but if it's an industry I know, a sector I know, I can get up to speed in 2 or 3 weeks. Sometimes it takes me a month, sometimes a little longer. But if I have to like boast about how long I spent studying a business, then I do not understand it well enough, in my opinion. Um, you know, yes, most of these companies I've been following for 10 years or longer, but I don't think that in and of itself gives me any sort of special knowledge into these businesses. There are some companies that I've been following for less than a year that I think I know just as well as companies I've been covering for 10 years. Um, and quite frankly, I can get probably a quarter of the way there in a day. Honestly, some things just slap you in the face. It's just the moat is so wide. The business and the assets are so unique. The management is such a standout, owner operated, um, culture that is economically aligned with their outside shareholders. Sometimes these things just become obvious very quickly. But to answer your question, quantitatively, the vast majority of the holdings will have already achieved scale. So these are not going to be micro caps, and there will be, few small caps. They will have healthy balance sheets, often with net cash. They will have high and or rising returns on invested capital. They will have stable and preferably growing streams of free cash flow, high terminal values, and long runways of per share earnings growth. Sticking with quantitatively, based on my analysis, these businesses will have high barriers to entry, wide and sustainable moats. Several will operate in oligopolies or duopolies. And when you're in an oligopoly or duopoly, there's not a lot of change in market shares. Market shares in oligopolies and duopolies are high and stable. And so these oligopolies and duopolies will have high and stable market share, pricing power, and limited competition, quite frankly, by definition. Others will have leading market share, but in a highly fragmented industry, which provides a long runway of profitable growth through both organic growth, taking market share, and through consolidation or M&A, because it's such a fragmented industry. And then qualitatively, the businesses will offer strong value propositions. They're going to be solving big, important problems. I've got to believe that these businesses are resilient and adaptable and protected by what, I already said, sustainable competitive advantages. And they have to have that advantaged owner-operated culture.
And I love that, by the way. When I hear, and I'm guessing when listeners hear industrial and infrastructure portfolio, they probably think, okay, he's cornered into, he's got to own general contractors or construction companies exclusively, that kind of thing, railroads. But it is a lot broader than it sounds. Can you give some examples of industries where, well, maybe not industries, but companies where they sneak into that category and they are a part of that category, but people might not think of it initially?
Absolutely. This is like one of the funnest questions that I've been answering recently. So you mentioned railroads. Those clearly fit. If you look at a map of a railroad in the US, by the way, people call railroads oligopolies. They're really duopolies because you have two class ones on the West Coast and two on the East Coast. It's really a duopoly. But even if it was an oligopoly, these are wide modes. And if you look at a map of their tracks and a map of the sort of gateways they have into Mexico, for example, that's the moat. I mean, it's a visual of the moat. No one can recreate this. No company can recreate this. And so, railroads clearly fit. They're 4 times more fuel efficient, energy efficient than trucks. By the way, trucking transportation companies clearly fit. These are companies moving our commerce and economy here in the U.S. You mentioned contractors, engineering construction firms. Those clearly fit as well. There's one in particular that has built out 50% of the transmission lines in the U.S. All right? I mean, think about that. Think about a moat. Think about the compounded knowledge this one company has built up, building 50% of all the transmission lines in the U.S. That's a moat. But let's take, so infrastructure is bigger than AI, okay? AI is the sort of, theme of the day, and rightly so. But infrastructure is bigger than AI because right now infrastructure encompasses AI, includes AI, at least the infrastructure level of AI. And so if you think about an AI data center, anything that is included in building out that data center is game for the portfolio. So the construction firm that builds the box, that's included. The GPUs and CPUs, the semiconductors that go into the data center, that's included. The servers, server racks, that's included. Any wiring, copper or fiber optic, and cabling is included. The networking gear that connects these servers and that connects data centers to one another, so switches and routers, that's included. Any sort of electrical component, sensor, or connector is included. HVAC or liquid cooling is included because these data centers run hot. Actual data center REITs, actual companies, hyperscalers that own and operate data centers. You could literally go on and on. And that's just data centers. If we think about with industrials, we touched on transportation. That's just one vertical of industrials. There's 4 or 5 or 6 other verticals that I'm highly interested in. And then if we think about housing related, that's everything from a land development company to a home builder to third-party companies that help install certain products in that home, such as roof trusses, floor trusses, insulation, building material and product companies that sell everything from paint and coatings to cabinets and flooring and roofing and siding. Any company that services a home, pool maintenance, pest control, plumbing, emergency plumbing, anything like that, landscaping. So, banks that give home loans, if that category of company ever becomes attractive, home insurance companies, companies that allow people to rent out their homes and earn income. So, this is a very broad and diversified pool that I can fish.
Yeah, the universe for companies is so much bigger than you initially think when you just hear industrial and infrastructure. But I
That's
do
it.
want. Okay, go ahead.
One of the things really quickly on the portfolio construction. Maybe most importantly, I want to invest in companies that do hard things and do those hard things well. Largely this portfolio will be investing in companies that take a long time to scale up. By long time, I mean years. How long does it take to build a new semiconductor fab, foundry? 2-3 years to build these things. And it takes $20 billion to build a state-of-the-art AI fab, basically, foundry. Who's going to compete with that? No one has $20 billion to compete with that. That's why these companies have earned monopolies, basically, right? So companies that take a long time and require just almost unimaginable amounts of capital. Those are types of companies I'm looking to invest in, as long as they're generating high returns on invested capital. And these companies do exist. I believe things that take a ton of capital and a ton of time create some of the highest barriers to entry and some of the widest, most defensible moats. This is pretty unconventional. I mean, if you think about it, there are a category of companies, let's call them profitless SaaS, that the market is rewarding right now with arguably, in my opinion, insane valuations because they can quote unquote scale up quickly, right? But if you can scale up really quickly, then the barriers to entry aren't there to protect you. You can scale down just as quickly. And a lot of these companies, they end up, growing too fast sometimes and flaming out sometimes. So I really want things that are hard to do, and that difficulty, that complexity creates a moat. Some companies, by the way, have a moat. A moat that's not often talked about, Ryan, is portfolio complexity. I did a show on a semiconductor company, an analog company, on Chit Chat Money, and we did a deep dive on this company. That one of that company's largest sources of moat is that it sells 100,000 products. That portfolio complexity, could you imagine starting a company to compete with that and say, oh my goodness, we have to come up with 80,000 or 100,000 products to compete with this firm? It's almost impossible to do. It's very, very difficult. That's a moat that never gets talked about, is portfolio complexity. I love that type of moat.
Yeah, one of the companies that comes to mind for that is like 3M. You can compete on one product, but to compete across tape and every other category that they have, the hundreds of thousands of products, it's quite difficult to do.
Yes.
I do want to talk about your portfolio management approach, because it's kind of a unique challenge where and most listeners, they might not be launching a fund, but maybe they've gotten a lump sum before. They've gotten a lot of money at once, and they've got to put it to work, I guess, or they're planning to put it to work on a certain date. How much do you think about, I guess, first of all, how do you approach that?
Mhm.
Secondly, how much do you think about the broad market? How much, like, if we feel like the market generally, and I'm referring, maybe let's just take big tech, and
Mhm.
it feels expensively valued or trades at multiples that it hasn't in the past, how much do you give that thought? And what impact might it have on your actual approach to portfolio management?
It's such a wonderful question. So, as Howard Marks suggests, I try to take the temperature of the market. I try to gauge sentiment. Um, and right now, things seem pretty silly to me. A dude paid $6 million to eat a banana. I don't know if you heard about this, but there was a banana that was duct taped to a wall, and a dude paid $6 million and then ate it.
I
Um,
I did not hear about this.
Google it. Google it. It was
That's
banana
incredible.
art. It was a banana and a strip of duct tape taped to a wall. I'm not criticizing the art. Art's in the eye of the beholder. If that's art to you, that's art to you. Some dude paid $6 million for this art and then ate it. Um, you know, earlier in 2024, everyone knows his name, Roaring Kitty posted a cartoon of himself like waking up or something, like sitting up in a chair, and the world lost its mind, the investing world at least. And then 100,000 people went and watched this guy talk about his trades on YouTube, right? And so these things start adding up and you start seeing signs. There's a hawk to a coin. There's a fart coin that has a market cap bigger than half of the Russell 2000. None of this makes any sense, and maybe people just think it's funny or something, but I use it to gauge, you know, psychology, sentiment. And right now things seem pretty out of whack to me. Um, at the valuation level, if you look at the S&P 500, if you look at, half a dozen different valuation metrics, the S&P 500 is valued in the 97th percentile of where it has historically traded, which means um, it's more expensive than it's been 97% of the time in history, or it's only been less expensive 3% of the time in history. Some of the metrics are at 100%, which means it's never been more expensive. The one that the if you want to call it metric or gauge that I use most closely is actually not um, the market valuation, although I'm very aware of all of those metrics at the market level, at the index level, but it's the valuation of the companies in my universe, these 100 or so best of the best, what I consider to be the best, highest quality companies. And they're as expensive as a group on average as I've ever seen them in 20 years of doing this. Um, the global macro strategist from JP Morgan was on CNBC a week or two ago, and he reiterated what I just said, which is that quality has never been more expensive. Goldman Sachs has a wonderful, what they call X Tech Compounder Basket, ETC, and it's all the companies that you would imagine um, outside of tech that are high quality, profitable growth compounders. And that portfolio trades at a next 12-month PE of 28 on average. So quality is expensive right now. And so these are all things that I consider when I'm launching this portfolio. All of that being said, um, I have a hypothetical portfolio that's ready to go. The only reason it has not launched yet is because our firm would like to officially launch the new um, Bastion website. The website is going to be lastbastion.com, and officially launch all of our portfolio manager newsletters, which will launch in the next week or so. So they just want that to launch before I launch the portfolio, but there's a hypothetical version ready to go. And I can tell you, Ryan, that it's 30 stocks, roughly, on a 2-year forward PE, so next 12 month plus one. On a 2-year forward PE, the portfolio is trading at a 20 times multiple. That's perfectly in line with the S&P 500. The S&P 500 right now is 22 times 1 year forward and roughly 20 times 2 years forward. So I'm at a market multiple, an average market multiple, but I believe that I'm investing in businesses that are far, far above average. A few other portfolio stats I will mention is the average company in the portfolio is 22% below its 52-week high. So on average, 22% below its 52-week high. So I'm finding some good values out there, but it's tough. And that's partly why I'm launching with 30 or 35% cash. The hope and the prayer really is that we get a large enough correction that I can deploy that cash quickly and size up some of the smaller 1% positions.
This episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they collect and summarize the best stock pitches and bring them to you in a single place. If you're a regular listener, you know that we use Yellow Brick every single week here on the podcast to discover new investments or just find reports on companies we've already heard of. Try it for yourself. Simply go to joinyellowbrick.com/chitchat and search a company or ticker you are interested in. You are bound to find a great report on just about any company. That's joinyellowbrick.com/chitchat.
All right, folks. If you're a regular listener to Chit Chat Stocks, then you know that we use finchat.io daily. FinChat is the complete stock research platform for fundamental investors. They have robust financial data on more than 100,000 stocks globally, including company-specific segment and KPI data. Want to see Google's Cloud's quarterly revenue growth? FinChat's got it. Like to track PayPal's take rate? They've got that too. And they recently added sell-side conferences and insider transactions to the platform. Best part is it's completely free to sign up. However, if you want to get unlimited data, you can use our link finchat.io/chitchat to get 15% off any paid plans. The link will be in the show notes.
Has that allotted cash amount? So you've been thinking about this portfolio for a while now, and I believe you said you started in August.
Started doing the research, working on it in August, yes.
Okay. Has that allotted cash amount gone up since that point in time, or has it been?
I didn't start putting the portfolio together. I started researching the stocks, putting some stocks on the side, but I didn't start working with weightings until about 3-4 weeks ago. So
Okay.
I didn't come to that cash decision until roughly a month ago.
Okay.
And once again, 30% is just what I'm launching with. That will not be normal. I think a normal cash position will be roughly 10 to 15% on average over time.
Okay. And you mentioned 30 holdings. Is that a strict limit or?
No.
Okay.
I am going to do everything in my power to avoid as many strict limits as I possibly can. So S&P Dow Jones indices recently put out that only 9.9% of professional portfolio managers have beaten the S&P 1500 over the last 10 years. So less than 10%, and I can, if you want to put this in the show notes, I'll send you the link. Less than 10% of professional portfolio managers have outperformed the S&P 1500 over the last 10 years. And these are brilliant teams, brilliant investors that have great processes and structures in place, people that I admire deeply. But I think one of the problems is they have too many restrictions, Ryan. Too many restrictions. So, I think 30% feels good 30 stocks feels good to me right now. 3 years from now, 20 may feel good to me. I can go really anywhere I want. I would like to stay within 20 to 40, which is a pretty big range if you think about it, only because my long-term goal is to turn this into an ETF, because that's the most low-fee, tax-efficient way that I can invest on behalf of my clients. I say long-term because ETF break-evens, you need 30 or 40 million dollars to make the economics work, and I'm not there. I'm launching a new fund. And most ETFs really want you to be in that like at least 20 stock range. And so I'm going to manage this as if I could turn it into an ETF tomorrow, although I won't be turning it into an ETF tomorrow. That's just my long-term goal and plan. But no, Ryan, 20 to 40 stocks, let's say, that's a big range. Look, I can think pretty far outside the box when it comes to what falls under industrials, infrastructure, and housing related. I'm not supposed to mention a stock, but what the hell? Before we came on, you said it sucks you can't put something like Visa in the portfolio or something to that effect. And I said, hold on, I can absolutely put Visa in an industrial portfolio if I choose to, when the valuation is right. And I this was completely unplanned. We were talking beforehand, and I said, did you know that Visa owns and controls 10 million route miles of telecommunications infrastructure that makes its global network work? And then I said, to put that into reference, the circumference of the earth is about 25,000 miles, and Visa has 10 million route miles of infrastructure. And then I told you, if you think about the two sort of metaphors or images investors always use to refer to these payment processors, it's either a toll road, a toll booth, or electronic rails, like a railroad. Those are two infrastructure metaphors. It's just my point is, I can think pretty far outside the box when it comes to including the best businesses in the world in this portfolio.
Yeah, and for all the listeners going through companies in their mind right now, you think about big tech. Those all have heavy, I think all of them, just going through them in my head, all have heavy infrastructure elements to their business. Amazon specifically is like cloud is the largest profit pool for them. So there
The
are
original clouds they built out were actually a layer of the cloud stack called IaaS, infrastructure as a service. Now, Amazon Web Services, here's another company that I just mentioned. Amazon Web Services, for sure, has now invested up and down that stack. So it's not just an infrastructure cloud company anymore. It absolutely is an infrastructure cloud company, but it's also platform, right? It's also getting more into SaaS. So the I, the P, and the S, the full stack of cloud solutions. So absolutely, great example there, Ryan.
when, let's say you discover a new company that qualifies, it meets everything for you, and we're going to go through what everything is here in a second, valuation, all that. What's the maximum allocation you're willing to put a company at for the portfolio? Do you have a maximum allocation, or do you kind of you
So
haven't put any constraints on yourself yet?
I don't want to write down those constraints, but in the back of my head, I definitely have constraints when it comes to that. So as a broad framework for portfolio management, position sizing at initiation, at cost, a 3% position at initiation, I'm considering a core position. A core position meets all of the quality criteria that we discussed earlier: quantitative and qualitative quality, business and managerial quality. So it meets all of the quality criteria, and it's trading at a discount to my estimate of intrinsic value. That's a 3% position, meets quality and discounted valuation. A 5% or higher, I'd be happy. I pray for an opportunity, Ryan, to find an opportunity that is such a slap you in the face opportunity that I could initiate a position at 8 or 10%. I'm praying for those opportunities. Think Microsoft 10 times free cash flow in 2014 when Satya took over. 10 times free cash flow. Think Apple 2016 when Buffett started buying at 9 times earnings or 10 times free cash flow. Okay? Those sort of generational buying opportunities, I would love to, initiate at 8 to 10%. But so 3% is a core position, quality and discounted. 5% or higher is a core position, but severely discounted. And then a 1% position meets all of the quality criteria, but it's trading at fair value. So really offers no or minimal margin of safety. Now, I want to stress this. A 1% position is not a silly, gamble, speculative rank speculation gamble. A 1% position meets all of the quality criteria. It's just trading at fair value. Two things about fair value. One, I'm comfortable paying fair value for greatness because there is almost an inordinate amount of research showing that quality businesses outperform the market over time. And these quality businesses are no secret. We all know who they are and what companies they are. And so they trade at premium multiples. Even though they trade at premium multiples, have traded at premium multiples historically, they still outperform the market. That tells you that the high multiples they traded at were not high enough. So I'm comfortable paying what I believe to be fair value. I prefer to buy greatness when it is absolutely hated and just puked out by the market. But if I don't have that opportunity, I am comfortable paying fair value. The second thing about fair value is fair value does not mean the stock price cannot go up. Fair value does not mean I don't think the stock price could potentially go up. Because remember, I'm buying what I believe to be greatness. I'm buying companies that I believe have a growing intrinsic value. And so that just means that I think my returns, if I'm paying what I believe is fair value, will come from growth of intrinsic value per share and maybe some dividend yield rather than multiple expansion. Or if we think about it in a DCF framework and not a multiple framework, fair value is the price you can pay and earn your discount rate, earn your required rate of return. So hypothetically, if I run a DCF on a company and I come up with a range of estimated values because I avoid precision at all costs. I don't, Ryan, this will be a theme. I don't want to box myself into anything. I think in wide ranges, wide error bands for the most part. But if I come up, I run a DCF and I come up with a stock that I think is fair valued anywhere from, from 70 to 150 or something, but my sort of middle of the road valuation is, 1 or 110, $100 or 110, whatever it is. What that means is if I think fair value is $100, that means I think I can buy the stock at $100. It means I think I can pay $100 and still generate 10% annualized return if I'm using a 10% cost of equity.
So let's talk about some of those opportunities, the type of opportunity, type of investment that you're looking for. Is this more of a swing for the fences, looking for 10 baggers or even higher, or is it base hits? I guess, what's your approach to trying to identify new opportunities?
I would just, if I was asked what kind of, hitter I am, I'm more of a Tony Gwynn, Ted Williams, base hits, doubles, some triples, and occasional home runs. That's historically how it has worked out. Let me also say, I've had a lot of strikeouts too, but I can't think of a time that I've ever in my life looked for 10 baggers in the sense that I'm going through the research and saying, do I think this could be a 10 bagger? I have ended up investing in several of them. I currently have several of them in my portfolio. Once again, balanced against some, down 50%, down 70%, down 80% that I've invested in as well. But I don't look for them. It's not a question that I ask as part of my checklist, but I end up in buying them because one, I think I'm good at identifying long duration profitable growth, with an emphasis on long duration. Profitable growth extended out over a long, long runway. I think I'm good at identifying that. And I know I'm good at holding them for a long time because I just don't even really log into my brokerage account almost ever. I just let the winners run. I know I'm good at that. And that's what it takes. Compounding is this eighth wonder of the world. It's just magical force that's just really a gift, and it's spectacular, but it takes time for compounding to really kick in, for the exponential part of compounding to really kick in. And so, the bias is to let our winners run and to really hold on as long as we can. As long as that valuation does not balloon outside of a zone of reasonableness, and it stays sane. Because, it's just so hard to part with a company that you know so well, that you're so comfortable with, that you have so much conviction in, that you have conviction has a decade plus runway of per share growth, per share profitable growth. It's just so hard to part with that, especially if it's a big winner, and then you have to pay taxes, and it's just really hard to do. And then you have to replace it with something that you may not know as well or may not be as high quality, that you don't have as much conviction in. So I've ended up owning, a lot of big multi-baggers. Although I have not gone through my checklist and said, is this a multi-bagger? Does it have multi-bagger potential? In 2020, I was on Motley Fool Live with Bill Mann, and completely unscripted, we answered a viewer's question on what qualities do multi-baggers have, or using pattern recognition, what qualities do multi-baggers have? And so Bill Mann and I, live, extemporaneously, unscripted, just started batting ideas off of each other. Okay, what qualities do multi-baggers have? And on that show, we came up with a framework. And so first, Bill named these companies mutants. So if you think about the $1 trillion club, right? Like the largest companies in the world, which is now the multi-trillion-dollar club, really. And so Bill named them mutants because they're just so strange and rare and unique. And so then we called this framework the triangle of mutantness, because we came up with 3 qualities. And one is these companies have a product or service that fundamentally changes the way we work or live. Fundamentally changes the way we work or live. If you think about it, like a certain, streaming company fundamentally changed the way we watch TV shows and movies, right? A certain, internet company fundamentally changed the way we consume information, right? A certain social media company fundamentally changed the way we communicate with each other. A certain retail, we already mentioned Amazon, fundamentally changed the way we shop, and then fundamentally changed the way enterprises rent, I was going to say purchase, but basically rent compute space. Okay. They fundamentally change the way we work or live. And then, this is just the first point, you also occasionally get a product that is just like, it almost is more than fundamental in how much it changes and amplifies everything, Ryan. So I did mention Apple because of when Buffett purchased it. So the iPhone amplified each and every one of the companies I just mentioned, because now you could shop on your phone. You didn't have to be at your desktop. You could stream a movie or a TV show on your phone. You could talk and chat in social media on your phone. You could consume information or YouTube on your phone. There's no question that each of those companies, each of those trillion-dollar companies that I just mentioned, are bigger and better because of the iPhone. There's just no question. The iPhone amplified everything by putting this supercomputer in your pocket or in your pocketbook, wherever you hold it. Every once in a while, a product comes along that is a true game changer. Now, you have companies and management teams saying they have a game-changing product all the time, and it's total nonsense. It's total nonsense. So the iPhone was a game changer. The A100, the A100 GPU was a game changer. It was a game changer from NVIDIA in 2023. Because it made ChatGPT and all these other generative AI and large language models bigger and better and faster and more powerful. It made them possible. Okay. And now we're on the H1. Now we're on the Hopper. But what NVIDIA did with the A100 was a game-changing product. And then what they did by going on a one-year cadence, it changed the world. It was when someone with the A100, okay, product says that they're now moving to a one-year cadence, every single company down the supply chain throughout the ecosystem across the world now becomes a one-year cadence. My point is, every once in a while, you have a company that is it. There's not even a word for how big of an impact it has and how that impact ripples across not only the technology world, but the world as a whole. So the first quality of these 10 baggers that we recognized and we called out on the show in 2020 was fundamentally changes the way we work or live. The second one is saves the user time or money or both. If you think about all the companies we just talked about, they save people time. Amazon, cheaper to shop, right? And it's faster. Google, you don't have to go to the library to buy books. You don't have to go to a bookstore. It's free, right? All of these companies, Netflix, you don't have to go to the movies. You don't have to spend money at Blockbuster. You don't have to spend money on overdraft fees or late fees, whatever they're called. So these companies fundamentally save people money and time, which are two of the most sought after resources in the world. Unfortunately, we can't create more time. It's hard to do. And then the third is they are founded and run by a brilliant and capable, not just brilliant. There's a lot of brilliant people that can't get shit done. Brilliant and capable of bringing their brilliance to fruition, to reality. So brilliant and capable and really a maniac. If you think about some of these founders, they're maniacal. And so those three really create the triangle of mutantness. And then if there's a fourth that I would just add, it's that these companies have created second acts and sometimes third acts. And so they stack these S curves on top of each other. So you have one S curve here, and then one here, and then one further down the road. And by stacking these second and third acts on top of each other, what that does is it lengthens the runway of profitable growth. We talked about duration of growth is very important to my framework. It lengthens the runway of profitable growth and expands the total addressable market. So I think that's how you would go about identifying 10 baggers, but no, it's not really something I think about.
All right, listeners, we've got a new sponsor here on Chit Chat Stocks. The name is Blue Chippers Club. Blue Chippers Club was recently started by two friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this awesome community, everyone gets to share and break down their portfolios with each other, participate in weekly calls, and compete in fun portfolio performance competitions. I really like this idea, and it's why we're promoting it here on the show. In fact, Brett and I are in the community ourselves and enjoy just how much value we get collaborating with other investors. When I first got into investing, a role model of mine recommended that I build a network of or community of friends to bounce investing ideas off of, and Blue Chippers does just that. If you're interested in joining, head on over to bluechippersclub.com and hit apply. Right now, it is completely free to join. The link will also be in the description.
Heads up, folks. Interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/Chit Chat Stocks.
I like that. The triangle of mutantness.
Mutantness.
And it's one of those things. It's like you can't put that in a model. You can't put like if you were writing a model in 1997 for Amazon, you're not going to say, "Oh, in 2010, it's the company's biggest rivals are going to be paying them or renting compute power from them." It's just like you get laughed out of the room, but it's one of those intangible things that when you have creative management teams that have shown an ability to execute in the past, they can kind of reinvent themselves and expand their addressable market. So you mentioned kind of the multi-bagger characteristics, even though that is not specifically what you're looking for. I also wanted to ask about businesses with high terminal value. Are a lot of those qualities or characteristics the same?
I think a lot of them definitely are. I mean, what's the formula for terminal value? First of all, let's take it even a step back. The formula for terminal value is not an investing concept. It's a mathematical formula for a perpetuity because we don't have a better option. That's as good as we have. We can't see into the future. The future is impossible to predict. And so what we try to do when we're building these models is we try to project out either as far as we think we can see or until we think returns on invested capital are no longer above cost of capital. So you try to project out as long as you think the company can earn excess returns. That's called a fade period. Excuse me. And beyond that project, and I don't know how far you think you can see into the future, but for most people, it's probably 5 to 10 years or maybe a little longer. It's really hard to do. But beyond that, we go from year 11 until the end of time, not until the end of the life of the business, because we don't have a formula that accounts for the end of the life of a business. We have a formula that accounts to forever, to perpetuity. So the formula is the cash flow in the last year of your projection period times 1 plus the growth rate that you use in that terminal period divided by your cost of capital minus that growth rate. And then you have to discount all that back. But I mention that because you have to think about growth rate, the G, and you have to think about cost of capital, the riskiness of that growth. But if you think about things with really high terminal values, I like to think about companies where the product is timeless and generational in nature. So look at how the value of sports teams, Ryan, have just been exploding into really the tens of billions of dollars lately. And I think the reason is because everybody loves sports and professional sports teams build these generational fan bases and they pull at our heartstrings. I don't have kids, but I have 8 nieces and nephews. And I can tell you that my 2 sisters have been dressing those kids in Saints black and gold since they were born, since they were infants. Since they were literally newborns, they've been in every Sunday during the season, black and gold. Okay, and when it's football season, purple and gold for LSU. So parents pass on their love of their home teams or their alma maters to their kids, and then their kids pass it on to their own kids, and on, and it keeps going. And, just to give an example, I don't watch a lot of sports, but I'm very observant. I know what's going on around me. So in 2010, the city of New Orleans was on its ass. We were reeling, okay? And the reason is because we took a couple of really severe blows, as did the country as a whole. So New Orleans is a tourist destination, and our economy is based on hospitality and tourism, people coming to visit the city. And in 2001, after September 11th, people didn't want to get on planes for a while. So they didn't come to New Orleans in 2001, and that hurt the economy. And then in 2005, Hurricane Katrina flooded 80% of the city. And I'm not talking about, a couple inches. I'm talking about, in places 5 to 10 feet of water. It flooded 80% of the city of New Orleans. 80%. And, that created like generational trauma on it, like epigenetic type of trauma for our city. I'm serious. But we're resilient, and we have such wonderful character. And so we fought back. In 2008, the global financial crisis hit. And once again, that affected everybody across the globe. But it affected us here in New Orleans too. It hurt our economy too, because people cut back on travel again and on vacations. So there was like 1, 2, 3 blows in a row. 2010, Sean Payton, Drew Brees, and New Orleans Saints win the Super Bowl. And it lifted us up. It lifted our spirits. And Sean Payton and Drew Brees and the rest, every member of that team are like prodigal sons of New Orleans now. And what it did emotionally to lift the city up, I experienced firsthand. My parents at the time worked in the hospitality industry. I can't put into words how powerful that was. And, New Orleans just went through something really tough 2 days ago with a terrorist attack. And, the city's resilient. It will fight back and recover. But that trauma stays with you. But I just think that like sports teams, the reason they're so valued and they have such high terminal value is because this cycle of like generational fanship and love for their teams is passed on generations. And so that creates high terminal value. And even when teams are not good, your fan base sticks with you. If you look at luxury good companies, mainly out of Europe, they have high terminal values because their goods are timeless. Once again, timeless and generational. Those are like 2 themes when I think of terminal value. The Birkin bag is not a trend or a fad. It's not fashion. What it is timeless. It's iconic. It doesn't go out of style. It doesn't go out of fashion. So the bags command these high prices, and they hold their value. That's terminal value, holding your value. The other thing that luxury good companies, by the way, Ryan, don't do, because they're these billionaire families, and their number one goal is to protect that generational wealth, family wealth, and then grow that wealth for the family and for their aligned shareholders. They would never rush something out to market. They're not growing for growth's sake, right? Like a certain cybersecurity software company allegedly released a product last year before it was adequately tested. And, this was a very good company in the sense that, or at least the product was in high demand in the sense that large parts of corporate America used it. And so when this product failed, it brought down parts of the internet. It brought companies to their knees. Now, I don't know if it was adequately tested or not. I don't really particularly care. The lesson, though, is that these luxury good companies would never, ever, 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 ever in a million years do that. They have no reason to. They're trying to protect generational wealth. They're not trying to grow so that they can achieve the high multiple that the market has given to the company. Right? It's methodical growth. And so that type of mindset, I think, creates terminal value. The mindset of we're here to not lose the wealth and then grow it after that, smartly, intelligently, methodically over time. We're not going to release a product just to release a product because the market expects us to release a product on a certain time schedule to maintain a 20 or 30 or 40 enterprise value to sales multiple. It's almost ridiculous to think about. And then just culturally, I think companies have to have a culture of doing everything well. It's not just capital allocation. It's the blocking and tackling. It's the operations. It's the day-to-day small things that compound into high terminal values over time. And you have to have an organizational structure and culture that is able to pass down these lessons to the next generation of leaders. So I think it's cultural, I think it's generational, I think it's timeless. I think those are things that lead to high terminal value.
I like that. Yeah, with the luxury companies, you think about those brands. Obviously, they still have to nurture the brand. They have to be very selective in the products they release, and they're not going to rush anything to market. But the heritage can't be replicated. You think about like a Ferrari, for example.
Absolutely.
All the racing history. Like if you were to compete with Ferrari, you'd have to go back through the last centuries and win all those Formula One races and or not Formula One, but the Grand Prix
Absolutely.
back in the day. It's
Absolutely.
just it's not doable.
It's not doable. And just really quickly, I don't think Coca-Cola has the heritage of Ferrari. Maybe it does, but it has a heritage. And Coca-Cola's holiday commercials going back generations, people still watch those today. I know they do. People make compilations of those. And there's Warren Buffett at one point in time said he should have sold Coke when it reached 50 times earnings or maybe even 80 times earnings at one point. I don't remember what it was. But he didn't. And I think, Ryan, it's because of that heritage that Coca-Cola has, of that brand that Coca-Cola has. There's incredible intangible value in that recipe. And even if that recipe for Coke goes out of style, if people stop drinking Coke for whatever health reasons or whatever it is, Coke has a supply chain that reaches virtually every inch of the globe. Now, that last mile of that supply chain may be a basket on the back of a moped, literally, because the roads are not paved or they're over mountains or whatever, through water. It may be, on a canoe, that last mile. It may be on the back of a bicycle. It may be on a mule. But Coca-Cola has a supply chain that reaches virtually every inch of the globe. And so even if Coca-Cola goes out of style, people stop drinking Coke for whatever reason. I don't drink Coke. They can just insert whatever other beverage products they want into this global supply chain. And, Coke is a boring company. That's fine. I don't own shares of it. But there's attractive assets there, whether it's the brand, whether it's the heritage, whether it's familial, whether it's generational. parents pass down their love of Coke to their kids, believe it or not. I grew up in a Coke family. My mom drank 3 or 4 Cokes a day. She's still going, by the way. Literally. And so when we drank soft drinks in our house, it was Coca-Cola. There's never been a Pepsi in my house. I don't have anything against Pepsi. It's a great company as well. There's never been a Pepsi in my house. I'm 44 years old, right? So that's also generational. By the way, people are very particular about what they put in their mouth. It's very intimate what you put in your mouth. And we could do a whole session on beverages. Like, people will go around the world and try local beers, like craft beers from different parts of the world. Go to Colorado, you try local Colorado beers. You come down to New Orleans, you try a Beta. Go to New York, you try Brooklyn Lager. Same sometimes with wines, but not always with whiskeys. You go anywhere in the world, Johnny Walker, okay, is high end in almost any bar in the world, from Tiananmen Square to Timbuktu. It's incredible how people will experiment in some categories of beverage and maybe less so in other categories of beverage. By the way, while we're talking about moats, so I'll just come to me. Imagine trying to compete with a company that has been aging scotch for 15 years. It's going to take you 15 years to catch up if you're an upstart. It's like Macallan 12, Macallan 15, Macallan 30. You can't compete with that. You have to literally start aging this stuff now and wait 15 years. So there's a lot of companies that people consider boring or whatever that have the heritage that you're talking about, that have the brand loyalty that you're talking about. And that brand loyalty travels very well in some cases across the globe.
Yeah, you'd better have some very, very patient VCs if you're an upstart Scotch company.
In Scotch, exactly right.
All right, I've got a few closing questions here for you. I want to, I guess, maybe for anyone that's listening that's potentially interested in learning more about Bastion and your fund, what's the pitch, I guess? Why should investors invest their hard-earned money into Bastion Industrial and Infrastructure Fund?
Oh man. So this is all I do, Ryan. Like, I'm not married. I don't have kids. I don't even have a dog right now. This is all I do. It would have been lovely for my legacy to be building a beautiful family, but I didn't go in that direction. So my legacy and what I've been working for the last 25 years has been for this moment, to launch a portfolio and an investing strategy and manage it in the way that I believe to be the right way for my clients. Every aspect of my life is structured in a way so that I can be the best portfolio manager I can be. I don't play fantasy football. I played fantasy football once in high school. I was on a team with my friend Henry. In high school, I'm 44 years old. I don't golf. I don't hunt. I don't fish. I rarely watch sports. I have nothing against sports. I think they're wonderful. We just talked about the legacy that sports have and the high values that creates. It's just not how I spend my free time. My hobby is investing. My hobby is my career. My career is my hobby. It's what I love to do. I'm obsessed with it. And it's how I spend the vast majority of my time. That's the first thing I'll say. Second thing I'll say is I'm extremely laser focused and intense about trying to get better at investing every single day. Companies that have growing intrinsic values, their values actually grow a little bit every day. Berkshire Hathaway's float is coming in the door every single day. Berkshire Hathaway's free cash flow is growing a little every single day. Therefore, by transitivity, Berkshire Hathaway's intrinsic value is growing a little every single day. It compounds. I try to do that with myself as an investor. I try to work as hard as I can, as focused as I can, extremely intensely at getting better at investing every single day. I think I'm self-aware. I know what I'm good at in investing and what I'm not good at investing. I have humility. I am extremely transparent about my mistakes, and I try to learn from them, and I try to share those lessons with people. And then the final thing I'll say is, the reason I got into this in freshman year in college was because I found out my parents went broke. And my parents went broke partly because they made, really bad decisions and they had bad judgment when it came to money. But also partly because they got bad advice from financial advisors. And ever since then, I've wanted to be better. I've wanted to be the advisor people can rely on. And I've learned what good financial judgment is. I have good judgment. I think what separates good investors from great investors, several things. One is patience. I have that. I open my personal portfolio twice a year, maybe 3 times a year, and one of those times is to get my tax documents. Long-term horizon. I have that. My eyes are firmly set on the horizon. I'm thinking about these businesses in 5-year increments down the road, and I roll that forward every year. And so patience, long-term horizon, and then I think intensity is important. I do think you need to be intense if you want to be great in this business. Druck recently said that the first thing he does when he wakes up is turn on his Bloomberg. I don't know if that's before he brushes his teeth or empties his bladder, but it's the first thing he does in the morning. Okay, I'm the same way. I don't have Bloomberg, but I turn on my platform that I'm on. And similarly, Lee Cooperman, he's 80, he's 79 or 80, and he's still working 17-hour days. He said that recently in a book that he published that I read, which I highly recommend, by the way. And people were critical of that when I posted it on Twitter. And it's completely unfair to be critical of someone that you don't know who's doing something that he loves in the way that he wants to do it. And there are days when I'm working 17-hour days. It's not work to me. It's passion. It's obsession. It's not work. And so this is just really all I do. I go for walks to clear my head and stay healthy. I go to the gym to get strong, stay healthy, and clear my head. And I travel, but when I'm traveling, I'm reading and studying about investing. So I just think that I've built up a skill set. I think I know what I'm good at. I can dive deep into a company at the same time when I'm like sort of hovering above everything and trying to picture how it fits into a broader system and into a broader portfolio. And so I think that ability to like dive deep at the same time that you can like kind of hover above and figure out how it all fits into a broader investing framework and philosophy and portfolio. I think that's a skill set that I've built up over time. And I want it. And I'm hungry. And the most important thing to me is doing what is right for my clients.
Love that. Yeah, I've been hosting this podcast for, I want to say, a little over 6 years now, co-hosting it with Brett, who's not on today. But I gotta say, I don't know if we've spoken to anyone who's quite as passionate and obsessive about investing and getting better at investing. So I 100% vouch for you, John.
Thank you,
Now,
sir.
I am looking forward to monitoring your progress. How will you be communicating with clients? And I guess for anyone that wants to monitor the progress who might not be a client, how will they be able to do that?
So, thank you for this question. So, there's a really cool. There's maybe 4 ways. We're a firm about communication and transparency. Kale is always talking about staying on top of communication. So the first thing is we have boards, just like The Motley Fool has boards and chat rooms. We have boards. These are internal boards for our clients. And so our clients can call us or email us personally, one-on-one, with any questions they have, and we'll happily get back to them, as soon as we can. But a client could also choose to pose a question to us on the boards. And in that case, we would answer that question to everyone who's on the boards. It could be a question about our philosophy, about why we, purchased stock in a recent company, why we sold a recent company. Maybe there's a stock that's not performing well, and they're asking us what we think's, going wrong, or whatever it is. We have boards, and we love posting on those boards. So that's one way, is the boards. The second way is all the portfolio managers, including myself, will soon be launching our own newsletters on our new website. So the new website is lastbastion.com. And if you just go to the tab that says articles and click on that, then there is a page where you can sign up for our newsletters. You can sign up for all of them individually, or you could sign up for just mine. That's totally up to the individual. But if you choose, you could sign up for J Rose Notes, which is going to be the name of my newsletter. So just go to lastbastion.com, go to articles tab, and then you can sign up for my newsletter there. That's the second way, is the newsletter. The third way is we'll be putting out letters to our investors quarterly or semi-annually. And the fourth way is we're going to launch our own Bastion Fiduciary podcast, which I'm sure I'll be hosting or co-hosting some of those episodes, and I'll also be a guest on some of those episodes. So lots of ways to communicate with us on our boards if you're a client, our newsletters, which are available to anyone, not just clients, our investing letters to our investors, and then our podcast as well.
Okay, I think that's going to do it. We had some more questions, but we are running long, so I think we'll wrap it up there. And if anyone wants to reach out to John, learn more about the fund, either you can reach out to me and I'll redirect you, or you can go to lastbastion.com. He's also on Twitter as well. So lots of ways to connect with him, and I will make sure to add the link, lastbastion.com, in the show notes as well. With that said, thank you all for tuning in to this episode of Chit Chat Stocks. I want to remind listeners that anything discussed here on the show is not formal advice or recommendation. Myself or John may buy, sell, or hold any of the securities discussed on this podcast, so please do your own research. Thank you again for tuning in, and we'll see you next time.